Along with long-term investors and short-term traders, many different types of players are associated with the stock market. Each has a unique role, but many of the roles are intertwined and depend on each other to make the market run effectively. A broker executes orders on behalf of clients and can be either a full-service broker or a discount broker that only executes trades. The brokers act as intermediaries between the stock exchanges and the investors by buying and selling stocks on behalf of the investors. An account with a retail broker is needed to gain access to the markets. Meanwhile, a dealer facilitates trades on behalf of itself. Some dealers, also called primary dealers, also facilitate trades on behalf of the US Federal Reserve to help implement monetary policy. Broker-dealers are those that perform both responsibilities, such as traditional Wall Street organizations, as well as large commercial banks, among others. Portfolio managers are professionals who invest portfolios or collections of securities for clients. These managers get recommendations from analysts and make the buy or sell decisions for the portfolio. Mutual fund companies, hedge funds, and pension funds use portfolio managers to make decisions and set the investment strategies for the money that they hold. Investment bankers represent companies in various capacities, such as private companies that want to go public via an IPO, initial public offering, or companies that are involved in pending mergers and acquisitions. They take care of the listing process in compliance with the regulatory requirements of the stock market. Custodians and depot service providers are institutions that hold on to customers' securities for safekeeping to minimize the risk of their theft or loss. These institutions also operate in sync with the exchange to transfer shares to or from the respective accounts of transacting parties based on trading on the stock market. Arbitrageurs are traders who identify mispricing in the market for relatively low-risk profits. By doing so, they keep the market more efficient. Algorithmic and high-frequency trading programs are often engaged in this type of arbitrage. Stock exchanges operate as for-profit institutes and charge a fee for their services. The primary source of income for these stock exchanges is the revenue from the transaction fees that are charged for each trade carried out on its platform. We will talk more about stock exchanges in the following videos.